Hi, folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory in Birmingham, and I thought I'd reach out with a quick update on the most recent market action. Today is Friday, and we are in the 7th consecutive day of a market sell-off. The S&P 500 is down about 8.5% for the year as we speak right now. It's down about 2% today. And this sell-off is really being driven by almost pure fear. There's a reason why they make movies like Outbreak. These types of disease concepts scare people. However, in reality, purely from a lethality standpoint, the current outbreak is significantly less dangerous or significantly less scary than previous disease episodes that we've seen come out of China, whether it be SARS or MERS or the swine flu or any one of those other prior disease outbreaks. This one's a little more contagious. So it seems like it might be a little bit more likely that it spreads outside of China, as we're starting to see. However, from a pure lethality perspective, the death rate continues to be around that 2% number, 2 to 2.5%, which is certainly not as scary as some of the other disease vectors that we've seen. And I think for a little bit of perspective, just so everybody's on the same page, there are roughly 90,000 people, give or take, in the world that actually have contracted this disease, or at least that we know of. Whereas there are 20 million people in the United States alone that have the flu right now. So I think a little bit of perspective would be helpful on behalf of all parties. In terms of the economic impacts, certainly you're going to see an economic impact in the first quarter, and depending on how long the disease stretches out, that might stretch into the second quarter. It's actually, I think, quite amazing that China is actually starting to gear up to get their factories and manufacturing facilities and everything else like that running, which is actually a great sign if you think about how long the disease has actually been in existence in China. We're talking about, basically, putting people on quarantine and then bringing them back out and online, in a period that's measured in weeks, not months. So that's quite impressive and a good sign, I would say, globally. Even if you believe the more draconian scenarios that would say that, this type of economic activity or this type of pause in economic activity is going to be enough to, push us into a recession. And as a reminder, a recession is 2 consecutive quarters of, contracting economic activity. It's likely to be only lived as long as the virus. And that bounce back should be reasonably quick if the virus is the sole cause. It's not really analogous to either 2001 or 2008, the previous 2 cycles or the previous 2 recessions, where we saw asset bubbles pop, right? Whether it was the subprime mortgage crisis or whether it was the .com bust, both of those were difficult for the financial markets to deal with. And in this case, the financial markets are actually functioning quite well. The sell-off has been very, very orderly, which is a good sign for the overall health of the market. And if I think about the depth of the market sell-off, obviously when the market has an asset class that's overvalued or needs to pop, then that presents a problem. In this case, there's nothing that you can really point to that looks like that. So in terms of, how to be thinking about this as a long-term investor, the nice thing about what we're seeing is that bonds are performing exactly the way that you would want them to in a blended fixed income and equity account. So the S&P 500 is off about 8.5%. Bonds are up about 3%. So that's providing a nice cushion for those of you who own fixed income. And in terms of things to think about with your portfolio, now's a great time to be taking a look at various ways that you can manage taxes, right? So if there are legacy positions in your portfolio that you've been holding on to due to large embedded gains, this market sell-off obviously gives you the opportunity to look at some of those. We'll be taking a look at some tax loss harvesting possibilities, particularly for clients who invested sort of in the latter part of 2019. And we'll also be taking a look at rebalancing portfolios since, once again, there's been that large discrepancy between returns and equity and fixed income. So with that, please feel free to reach out to me if you have any questions, and I look forward to next week.